Hello folks, this is Peter Maris of the Resource Financial Group. It's April already, so I trust that you've either submitted your income tax data to your CPAs or you're very close to doing so. Today, we're going to talk about making your nest egg last throughout retirement. Folks, I've been in the financial service industry now for 33 years. And one of the most crucial mistakes I see individuals make, especially those do-it-yourselfers, is investing their money the same way when they're in the distribution phase of the retirement planning process as they are doing the accumulation phase of the process. I like to refer to this with my clients as going up the hill or accumulating your nest egg and going down the hill, receiving distributions from your portfolio or nest egg. Think about it. When you're going up a hill or upstairs, and then you're going down a hill or downstairs, you actually utilize different muscles with each endeavor. Same with your money. Now, what do I mean? Well, folks, when you're accumulating your nest egg, the formula is rather simple. Invest as much money as you can, take as much risk as you can without losing sleep at night, and take advantage of tax-favored investments like 401k plans. Simple, right? Easy? Not at all. That's why we're here for you. Now, when you're ready to take distributions from your portfolio in retirement, it's a different set of rules. What do I mean? Well, when you're accumulating money, volatility in the financial markets is your friend if you play it right. When you're receiving distributions from your portfolio, volatility can devastate your portfolio and wreak havoc on your retirement. It can cause you to run out of money during retirement, and sometimes this has to do with the market, but mostly it's about planning. When you hear about financial markets, you frequently hear the terms bull market and bear market. What's the difference? Well, a bull market is characterized by rising stock prices over an extended period, typically driven by optimistic investor sentiment, economic growth, and increasing demand for securities. Most people feel that we're currently in a bull market. Conversely, bear markets, B-E-A-R, are often associated with negative economic indicators such as high unemployment, declining corporate profits, and low consumer confidence. These conditions can persist for months or even years, resulting in significant losses in stock prices and other assets. We all remember the Great Recession of 2008, 2009, where the stock market lost half of its value. Yes, something I don't think any of us will ever forget. Now that you have those two concepts in mind, let's dive into our topic, the sequence of returns. The sequence of returns refers to the order in which investment returns occur. It's a crucial concept to grasp because the timing of returns will significantly affect the sustainability value of a portfolio, especially during retirement. Imagine two individuals with identical investment portfolios but experiencing different sequence of returns. One might retire during a bull market, enjoying strong returns early on, while the other faces a bear market at the onset of retirement, eroding their portfolio's value. We have the benefit of utilizing something like this sequence of return calculator. Take the example of those two individuals with the same investment asset rate. The initial balance of retirement assets, let's use $1 million. You can see that over the span of 21 years, that the balance of investment is now a little over $3 million. Now, watch what happens when we change the returns, randomize the historical returns. The balance does not change. We talk about this as going up the mountain. Now let's take a look at what happens when you are on the other side of retirement heading down the mountain. Let's assume an 8% withdrawal rate, which is a little high, but for our illustration purposes, it's perfect. Depending on the returns, how much you withdraw, and the allocations made, you end up with period balance can shift wildly. In this example, it's at $442,100, and here it's at zero. Even though both individuals in our scenario had the same average annual return over time, the one who experienced poor returns early in retirement would run the risk of outliving their savings and running out of money during retirement. Sure, you need a little luck sometimes, but with proper planning, you can negate the sequence of return risk and have your nest egg last, providing you with a comfortable retirement. And if you're a client of our firm, rest assured, we have you covered. Well, folks, that's it for this month's video. Please remember that nothing in this video is a personal recommendation. If you have a question about your retirement planning, please call Amanda at the office. Let's set up some time to talk. We're here for you. Have a wonderful day, and we'll see you back here next month. Thank you.